In this lesson, we're going to cover topic 3.1 and also 3.2. So let's start. So 3.1, capital expenditure and revenue expenditure. So if a business wants to buy in, like, let's say that you have a McDonald's restaurant, and for it you need to buy in a soda machine. When a business buys in something that is a good or a service, it is also called procurement. Procurement means that a business is buying something in, whether it's a good or a service. In this case, we have a soda machine, and the soda machine is used by the business to make money in this case. And we will deal with it afterwards as well. Capital expenditure. Well, capital expenditure is basically an investment, and it's an investment towards the business's fixed asset. And if you don't know what fixed asset is something that a business has that they use. And examples of capital expenditure could be like factories, for example. And factories they invest in and they cost a lot of as well. And also like trucks, maybe. And you can always understand that capital expenditure is something that is usually very costly. And therefore, it is also covered by long-term finance. And long-term finance means that people take time to actually pay it back. And then you also have revenue expenditure. How it's different from capital expenditure is basically that it's everyday things that need to be paid. For example, salary and utility are very great examples of this. Salary you need to pay to your workers every month, and so utility you need to also pay every month. So revenue expenditure is usually smaller. It has usually smaller cost, and it's you can always understand that revenue expenditure is for everyday costs, not huge things as well. So let's take an example of a chocolate shop. I think that's a very great example to understand the difference between capital expenditure and revenue expenditure. So you have your chocolate shop. So the first thing that you have is your 100,000 euro chocolate machine. And the second thing is your $500 worth of cocoa beans that you have to buy in every month. So which one is the capital expenditure and which one is the revenue expenditure? Well, obviously this one is the capital expenditure, and this one is the revenue expenditure. And you can really distinguish them from how many times you need to buy them. Your capital expenditure, also your chocolate machine, you only buy once. That's it. However, your chocolate bean bag, you have to buy every month or how many times you need it. So let's do sources of finance as well. Topic 3.2. So internal sources of finance usually fall onto three categories. The first category is the business's profits. Business's profits are actually one of the best ways you can use this. And you always can keep in mind that this is the most logical as well. As business generates revenue, usually some of the revenue is put aside to create bigger projects or just reinvest into the company. The second one is personal funds. Personal funds is usually like the business owners. This is the one with the least amount of risk. Why so? Well, there is always risk for yourself, as if something goes wrong and then you might lose out on the money. But for the business, there is little to no risk. And the third one is the sale of fixed assets. So how to actually understand their difference? Well, business profit is just a profit that you generate from your business. Personal funds are usually the owner's own funds that they put into their business. It can be in exchange for equity and share percentage. However, it doesn't have to be. Sale of fixed assets, this is a bit more difficult. So let's say that you have the chocolate machine that you had before, and after 5 years the chocolate machine, like, you don't like it anymore, you need a different type. So you can always sell. So the sale of fixed assets means like when you sell your stuff that your business has to generate more profit. All of them have opportunity cost. What this means is that you always have to think whether, for example, the sale of fixed assets, you have to understand whether it could have been better to use the asset to generate more money, or whether it was best to sell it. Opportunity cost also is for personal funds, because you know that personal funds can be used in many ways. Then you have to really understand that if you used it in the right way. And same is for the business's profit. You understand that if it's best to reuse the profit or give it back as dividends to the shareholders. And you have to understand that if you're using internal sources of finance, then the best part is that you have way much less risk than other. So let's also cover. So you also have to know short-term, medium-term, and long-term finances as well, to distinguish them when you're doing business management exercises. So you usually have only 3 options: short-term, medium-term, and long-term. Well, the first one is obviously going to be short-term. And short-term is from anywhere between 0 years to 1 year. Then you have medium-term, which is from 1 year to 5 years. Let me put 0 to 1 years, 1 to 5 years. And then you have long term, which is anywhere from 5 years and on. So it can be 20, it can be 25, it can be 60. However, it has to be more than 5 years. So let's look at the external sources of finance as well. So the first one is equity finance. Equity finance means that you're essentially giving up a part of your business for money. And so you have your external sources of finance, and the first one is equity finance. Let's start with the business angel. Well, the business angel is essentially a person who just gives you money for a part of your business. Well, I think everyone has seen any clips from like Shark Tank, where they are just very wealthy. Business angels are very wealthy, rich businessmen who like to invest into businesses early on to get maximum profits. And they are always interested in investing into businesses before they are on the stock market. Then venture capital. Well, it's almost the same. However, this time you don't have a person, you have a corporation. So let's say that you have a business and the business gives you money. It's not a singular person. And in this business, there can be a lot of people. And the difference between venture capital and business angel is that there's a huge business controlling every fund, and not just a business angel, which is one singular wealthy rich business person. And then share capital is just when you have your company on the stock market, and then people can buy large sums, and usually people are paid back in dividends, and then people can buy because of that as well. So to go over it, business angel is a person who gives you money for a part of your company. Venture capital is usually a business that gives you money for capital, and share capital is when you have your business on the stock market and people can buy parts of it for money. So debt finance is the second part of external sources of finance as well. So when you're talking about debt finance, you usually have 4 types of debt finance. So the most common one is the loan capital. I think a lot of you know already what loan is, so I don't need to go that much into that. A lot of people take loans. However, if you want to take a loan as a business, you have to give collateral. And collateral is something basically that the business has to give to the banks where they take a loan. It's usually something, it can be a car, it can be a house, to show that they're actually going to pay back the loan. So, and loan capital doesn't usually have as much interest, and loan is something that is usually more as a long term as well. So overdraft. If you have bank accounts, usually some bank accounts even have it. So overdraft is essentially if you're going to a store and you want to buy something that is 100 euros. However, you don't have 100 euros, so your bank puts you into negatives. So to understand, it's basically a very fast loan. However, it is very high interest because the bank likes to take the interest. Then microfinance is usually finance in very small sums. What this means is that when you have a loan, you have to pay collateral to your loan. You have to give collateral to get the loan. However, the thing with microfinance is that you don't have to do it. And this is usually given to people who have low income countries who want to start businesses but don't have the opportunity to take a loan. And there is also one which is called microcredit, which is usually for women who want to start businesses and they have a hard time taking them. So to put it simply, microfinance is just a small loan. And to understand this, that it doesn't have collateral as well, because the loan is just so small. And the last one, but not the least one, is trade credit. And trade credit is basically when, let's say that you have your chocolate shop, which we had before, and let me draw the shop. Let's say it looks something like this. And then trade credit is when you basically borrow the supplier from the supplier. Let's say you have the cocoa beans, and then your supplier of your cocoa beans gives you, the chocolate shop, the cocoa beans for free, no cost. And when you sell the cocoa beans, you pay them back after like 30 days, 60 days, and so on. So essentially you are taking what you need to make the product, you make the product, you sell the product, and then you give it back. That's trade credit. You're essentially trading the supply and then giving back it as credit. And usually there's no interest involved. It's just a very quick, easy method. And also and there are also other external sources of finance as well that we have to go over as well. So the first one is leasing capital equipment. I think examples of this would be like when people use tow trucks, and I think we can even bring our classic example of our chocolate machine. You can always lease the chocolate machine, meaning that you get to use it. However, the problem with leasing is you don't own it, and if you lease, you just have to pay every month. So there are some positives and some negatives to it. The positive is that if something happens with your machine, you can just swap it out. You don't need to pay to fix it yourself, and like it's just a single payment. However, the negative with leasing is that you never own it. Therefore, if you would want to like sell it afterwards, you couldn't do that. And usually leasing is more expensive as well. Then crowdfunding. I think a lot of people know what is Kickstarter. So essentially crowdfunding is when like a lot of people, they don't gather up physically, but they can gather up online, and they give you money all together to start the business. So essentially they show support online. There are websites like Kickstarter when you can like send money. So usually there are 3 types of crowdfunding. The first type is that people give money. A lot of people give money as a loan. The second one is that a lot of people give money for a small part of the company. The third one is that people give money to actually like receive the goods. So when you're like crowdfunding a chocolate companies, just you give them a lot of money and then you get chocolate. And then the fourth one is a bit different, but then it's just like donating, when you're just like giving money to see a business succeed and you don't expect anything from it. So how to recommend the right finance type to a business? You have to really look at 3 things: the size, purpose, and risk tolerance. So you know that when the business is quite small, then it doesn't have a lot of options to get finance. They cannot get loans because they don't have any collateral, and they cannot maybe share their partial of their business as well to a business angel or venture capital as well. And then when it's small, you want to usually rely on internal. However, if the company is big, you can go abroad and take more opportunities as well. And then the purpose, you really have to understand what's the purpose of your business. If the purpose of the business is to just generate revenue as much as you can, then you can always go to equity finance. You can sell a part and they will be very happy to invest huge sums. And then you can take loans. However, if the purpose is not to generate as much, let's say that it's a chocolate shop for like vegans. I wouldn't even say vegans, but it's a very niche and made to like sustain the environment. Then that means that you should have to look at different types of finance as well. And then also risk tolerance. Small businesses cannot take a lot of risks, meaning that you have to really understand what you actually can take. And and then you have to understand that big businesses can take more risks, they can take better loans, and then you have to understand, so can take risks. And that's it for this lesson for topic 3.1 and 3.2, and see you in the next video. Thank you.